You could be thinking right now, Adam, I don't want to wait 30 years to make money. You know, I don't have 30 years left, and I don't want to only get a 12% return. That's pathetic, right? Great. So I'm now going to show you active investing, where you can generate a lot more than 12% returns. In fact, you should be able to generate anywhere from 15% to 25% annualized returns by holding not for 30 years, but for a shorter period of time, like maybe just for 2 or 3 years. Okay. Now, so before I start, I'm going to show you a chart. Initially, the chart I showed you was a long-term 30-year chart, if you recall. Now, this is a medium-term chart. This is 5 years from 2006 to 2011. And in fact, this is one of the worst 5-year periods in the last 30 years. Why? What happened? In this period, we had the subprime financial crisis that happened from October 07 to January 09. So why am I showing you this chart? You know, why don't I show you a 5-year period that performed really well? Because I always believe that we have to prepare for the worst case scenario. I mean, what if this happens again, right? You can't plan based on the best case scenario where the market goes up. It could go sideways or go down, right? So let's imagine in 2006, you started investing in the market. So you started buying shares over here, right? When it was at about 11,000 points on the Dow Jones. And you bought it over there and you kind of like, okay, I'm going to hold on to it, I'm going to close my eyes. Like Adam said, it goes up and down, I'm not going to care. And sure enough, after 5 years, you look at your investment and where are you after 5 years? All right, you are, well, you started here and 5 years later, you're somewhere here. So, you know, it just went up slightly. It was, you know, hardly a good investment, right? And what if you open your eyes after 3 years? All right, you've been down, you know, 50%, right? And after 5 years, you just broke even. So you can see that the buy and hold method does not work all the time. In fact, the buy and hold method only works for the very long term when you're holding for 15, 20, and 30 years, because in the long run, it smooths out the market cycles. But in the short to medium term, you cannot just buy and hold. You can buy and hold for 5 years and end up breaking even or even losing money. So to make money in the short to medium term, you have to do trend following. You have to follow the trend. So what's trend following all about? The thing to understand is that markets move in trends or cycles, right? So there's a certain period of time when the market is on what is known as an uptrend. So on an uptrend, the market or the price moves in this fashion, right? It goes up, down, up, down, up, down, up, down, and so on and so forth, right? So this is known as an uptrend, okay? So on an uptrend, notice that prices still go down for a couple of days, a couple of weeks, but every time the price goes down, it goes higher. It goes down, it goes higher. It goes down, it goes higher. So it makes a series of higher highs, and a series of higher lows. Okay? So that's the definition of an uptrend. All right? Now, so if you take a look at the market in this period of time, that's an uptrend. As you can see, the price is making higher highs or higher high points and higher lows. Okay? Over here, this is an uptrend as well. The price makes higher highs, okay, and it makes higher lows. This is an uptrend as well, right? So uptrends happen when the economy is expanding, when it's growing. So you have to identify an uptrend the moment you see it. Now, uptrends don't last forever. Inevitably, uptrends will always reverse into downtrends. And downtrends happen during recessions and crises. Downtrends typically last for 2 to 3 years. So on a downtrend, what happens? On a downtrend, price doesn't fall in a straight line. Well, what happens is first, the price goes down, like so. Then it will go up temporarily. This is known as a rally. Okay, it's a rally. And that's where a lot of amateurs tend to buy, because they think, hey, I'm going to buy it there before it recovers back to where it was. But they do not know that it's a downtrend. So on a downtrend, every time it goes up, what happens? That's right, it goes lower. And it goes up, it goes lower. It goes up, it goes lower. It goes up, it goes lower. Okay? So on a downtrend, price makes lower highs. and lower lows. Okay, so that's a downtrend pattern. So if you notice from October 07 to January 09, this was a downtrend. You can see every time the price goes up, it goes lower. It goes up, it goes lower. It goes up, it goes lower. It goes up, it goes lower. So it's making a series of lower highs and lower lows. Okay? So to be a successful investor, you have to identify the current trend. Are we on an uptrend or are we on a downtrend? Now, if you want to make money consistently every single year, the way I do and the way my students do is this. The most important principle to follow is you have to invest with the trend. In other words, you only buy, you only hold the investment when it's on a very clear uptrend. Because on an uptrend, the statistical probability based on collective psychology is that prices will continue going higher. It's kind of like a river current. You always swim with the current. You go with the current, okay? You never buy, you never hold when the market is on a downtrend. Because on a downtrend, the probability is that prices will go lower and lower. So listen very carefully. On a downtrend, no matter how cheap it looks, do not buy it. Because on a downtrend, cheap can get cheaper, low can get lower, and you never know how low it can go and how long it's going to stay there. So you must always wait for a downtrend to reverse into an uptrend before buying. And if you can just follow this simple advice I'm giving you, it's going to save you a lot of money when the next downtrend happens. It's going to help you maximize your returns riding the uptrend. Does this make sense? So in other words, if you can identify the uptrend and buy exactly over there, right? So you buy at the start of the uptrend over there, and you sell over here the moment you see the downtrend beginning to form, right? And you get out before that horrible crash, so everyone dies except you. Everyone loses money except you. And then you identify the start of the new uptrend and you buy over there. Okay, and you write the trend up. It looks like it's going on a downtrend, so you sell over there. Okay, but reverses back up, buy over there. And write the trend up again. So in other words, if you could buy over here and sell over here, and buy back over here, and sell over here, and buy over here, sell over here, guess what? You're going to make a lot more money than everyone else who just bought and held it for 5 years. Let me say, Adam, if it's so simple, why doesn't everyone do this? Because very few people know how to read trends. In fact, many people say that no one can time the markets. Have you heard this before? I used to believe this rubbish, okay? And I heard this from finance professors in the university, and it's complete rubbish because they said, based on the efficient market hypothesis, based on the random walk theory, no one can time the markets. That's absolute rubbish, and I can tell you this. It is not that no one can time the markets, it's that 99.9% of people in the world cannot time the markets. But 0.1% of people in the world, the best investors, the best traders, can time the markets, and that's how they make money consistently every single year. So I'm one of those people who can time the markets. I'm going to teach you in this short webinar some of the basic skills you need on how to time the market trend. All right. So one of the ways you can do it is by using moving averages. Now I'll teach you all the different strategies in the Wealth Academy program. It's going to take about over 40 hours to train you in all my skills. But I'm going to show you my most basic technique, which is using moving averages. And you can get moving averages using any kind of charting software. So let me show it to you right now. So you're able to use moving averages by using any kind of charting software. And you can get all this charting software free from the brokers you're using, right? For example, I'm using Thinkorswim, and I'm going to use the charting software to analyze the S&P 500 ETF, which is the SPY. As you can see, that's the S&P 500 ETF. And you can see that the market goes on different trends. So over here was a financial crisis. You can see there's a downtrend over there. There was an uptrend over there. So a lot of people, what happens is they buy over there, and then when it goes on a downtrend, they don't know when to sell. They keep holding it, and they lose a lot of money. Now, of course, if they hold it for the long term, eventually they're going to make the money back in the long run. But my belief is, why wait so long to make your money back and break even in 5 years? Why don't you get out right over here before the crash and re-enter to catch the uptrend. So to do that, you have to use moving averages. So I'm going to use the software, and I'm going to put in moving averages over here. So I'm going to click moving average, and I'm going to use two moving averages. The first one is called the 50-day moving average, and that would be the 50 moving average. That would be blue. I use blue for the 50 moving average. And then I use the 150 moving average, which is green in color. Okay. So notice what I've done is I put in two moving averages, and you can see that the software will draw these moving averages for you very, very clearly. Okay, so let me just zoom in. Now, how do you read the moving averages? So this is the blue line and the green line. Okay, that's the 50, that's the 150. So the rule is really simple. That's the 50, that's the 150. Now always remember that when the 50 moving average is below the 150 moving average, it's on a confirmed downtrend. So you never buy when the 50 is below the 150, because if you buy, the probability is that prices will keep going lower and lower because it's on a downtrend. One of the ways I teach my kids to remember is, imagine this is a 150 kilogram man, a big man. That's a 50 kilogram man, is a small man, right? So when the big man is on the small man, what happens, right? It goes down. Okay, so you never buy when the 150 is above the 50. Now notice that on a downtrend, both moving averages are sloping down. Can you see they're both sloping down? Sloping down, right? There's a downtrend. So how do you know the downtrend has reversed into an uptrend? There are two conditions that must be met. The first condition is that both lines must stop sloping down. In other words, they must flatten or slope up, right? So you can see over here, the blue line has flattened and sloped up. The green line has flattened and sloped up. That's the first condition. Second condition is the 50 must cross above the 150. So you can see the blue line crossing above the green line. Okay, so the moment the 50 is above the 150 and both lines are flat or sloping up, that's a confirmed uptrend. That's how we know that we buy exactly at this point to ride the trend up. Okay, and you can see over here the 50 crossing below the 150, right? You can see it sloping down, sloping down. So the moment it crosses, you have to sell over there. Get out before the crash, buy to catch the new trend, right? So this is how you can read the long-term trends in the market. Let me show it to you on the slides. So let's take a look at how using moving averages would have gotten us much higher returns than just buying and holding over this 5-year period, right? So you can see on the chart, here's a 50 and 150-day moving average, which I just showed you on the charting software. And the software will draw these moving averages like so. And you can see over here, the 50 crossing above the 150, and there's a buy signal, right? The 50 is above the 150, we buy over there. And we write the trend up, okay? And you can see during these mini pullbacks, there's a pullback or a dip, and a dip, you wouldn't sell there because the 50 is above the 150 moving average. In fact, you can see that the 150 moving average, the green line acts as a support, right? Toing, toing goes up, toing, toing goes up. It acts as a support level. Now over here, you can see the price breaks the support level, all right? So that's an early indication the trend is broken, and you can see the 50 crossing the 150, all right? Notice the blue is sloping down, the green has flattened. So they must both change slope for it to be a reliable downtrend. So we sell exactly over here and get out before the crash of 07. And what we do is we wait for the 50 to cross back above the 150. Again, notice it's sloping up, it's flat. So we can buy over there, ride the trend up. Right, and you can see here, again, a dip, boom, it finds support at the 150. Now, over here, what has happened? It has broken the 150. So there's an indication the trend is broken. The 50 has crossed. What do? You sell over here. Now, once you sell, what happens? That's right, it crosses back up again. So note that we can't predict where the market is going. We can never predict when the trend will change. We're not here to predict the future. Only fortune tellers can predict the future. All I'm doing is to identify and follow the trend based on the moving average. So I'll buy back over here and write the trend up. So simply by following the trend without having to predict the future, would have bought over here and sold over there, getting us a 22.7% return in about 1.5 years. And then we re-enter over here back in 09. We exit in the mid of 2010 for 31% return over 1 year again. And then we re-enter over here and we exit for 19% return in 6 months. And the total return that you get is about 72.7% in 3 years. So instead of holding for 5 years, we only held for 3 years because for 1 year we got out of the market, right? So 72.7% in 3 years is more than 25% return a year just by following the trend. So this works on any market. Let's take a look at the Singapore Straits Times Index. And again, this is from 2007 to 2012. You can see if you bought here in 2007 and you close your eyes for 5 years, you open your eyes after 5 years, right? Where were you? You bought over there, here, right? You broke even after 5 years, right? And if you bought over there and you open your eyes after 3 years or 2 years, you're down 50%. So buying and holding works for the long term, but not for the short term. For the short term, you have to follow the trend. All right, so now putting the moving averages in, let's go for it. There we are. So we again place the 50 and 150 moving average. Now let's zoom in and let's take a look. So you can see the 50 crossing the 150. That's a buy signal, right? So we buy over there, we write the trend up, right? It's going up, write the trend up. So even though you see a dip here, you still hold on to the market because the 50 is above the 150. Now over here you can see the 50 crossing the 150, right? The 50 sloping down, the green is sloping down, so you exit over here. So you get out here, sell before the crash. Same as what we saw in the US market, right? Over here the 50 crosses back above the 150, what do? That's right, you buy it back, right, somewhere over here, right? Buy back over here. You write the trend up, okay? Now, let me ask you a question. Would you sell over here? You can see the 50 crossing the 150. Can you see that? Would you sell over there? The answer is no. Why? Because the 150 is still sloping up. Remember that a downtrend is only confirmed when both moving averages have flattened or sloped down. In this case, even though the 50 crossed the 150, but the 150 is sloping up, it is not a change in trend. So that's not a sell signal. You keep holding it, and sure enough, it goes higher. Okay? How about over here? Would you sell it over here? Again, the 50 has crossed the 150, but the 150 is still sloping up. So that's not a sell signal yet. You have to wait for both moving averages to flatten or slope down. So we don't sell it over there yet. Now let's hold on for a while. There we go now. Notice over here, both moving averages, let me zoom in, can you see they're both sloping down? That's right. So that is a confirmed downtrend. You sell before the crash. That's right. So again, if you just simply follow the trend with moving averages, you'd buy over here, you sell over there, all right? And what return do you get? Right, so you buy over here and you sell over there, right? You get this return, okay? And then it crosses, you buy over here. And recall that we didn't sell there because it's still sloping up. We sold here. Just like that. All right, so you can see the result over here. All right, so entering there, exiting there will get you 40% return in about a year and a half. And then entering over here, exiting there will be 39% in 2 years. So again, your total return will be 79% in 3 years, which is more than 25% return a year. Finally, let's take a look at the Malaysian stock market from 2008 to 2011 during the financial crisis. Again, if you had bought the KLCI index over here at 1,215 and you kind of held on for 5 years, 8, 9, 10, 4 years, you would end up at 1,404. So that's an 11% return in 4 years, which is about 2% plus a year, which is better than, it's just about putting in the bank, right? So again, if you put in the moving averages, all right, you can again make much better decisions, right? So the 50, 150, you can see that the moment you see the 50 below the 150, you do not buy. You avoid the downtrend. So anytime you buy on a downtrend, right, every time it goes up, goes lower, goes up, goes lower, goes up, goes lower. So these are where all the amateurs buy and they get flushed out of the markets, right? Wait for the 50 to cross the 150, buy it somewhere here when you see it crosses. Sloping up, that's right. And you exit when it crosses back down. 50 crossing 150, sloping down, exit there before the crash. So again, if you enter over there, exit there, you get 40% in 2.5 years. Again, it's 20% a year, all right? So you can see that using moving averages can give you much better returns trend following than just buying and holding, all right? And if you think that this is a great strategy, you're really easily impressed because this is the most basic technique that you can ever learn. Right? In fact, I just taught this to you in less than 15 minutes, okay? And when you come for my live course, which is a 40-hour program, it's about 3 days, sorry, it's about 4 days, okay? I'll do a live back test with you. I'll show you live by using the moving averages over the last 20 to 30 years, you make a tremendous profit in the markets, all right? But I can tell you personally, I do not use this method because this method is just too simple for me, all right? And the trouble with using moving averages is that they only work for indexes. They don't work for specific stocks. For specific stocks, you have to use many other kind of techniques like candlestick patterns, wave patterns, support resistance, and other indicators, which I'll teach you in Wealth Academy. So this only works for indexes. Now, even then, the trouble with moving averages is that they are very slow to react. It's a lagging indicator. So you can see, for example, the bottom of the market here, the bottom was 800 points. Can you see? It was 800 points. But by the time it crossed and you bought over here, you bought at 1,000 points. So you can see that the moving averages give you a very late signal. By the time you buy, you would have bought 200 points late. You have entered about 1 year late. Okay? And you can see the top of the market over here was about 1,593, about 1,006. By the time it crossed and you sold it at 1,004, you'd have missed again about 100 points. Okay? So as a professional investor and a trader, I can't afford to be slow. I've got to get in right at the bottom, right there. Okay? Or right there. And I've got to sell right at the top, somewhere over here before it crashes, okay? So in the Wealth Academy program, I'll teach you exactly how you buy right at the bottom and how you sell right at the top by using techniques like divergence, candlestick patterns, trend line support and resistance, all the advanced techniques that I'll teach you to time the market with the greatest precision. Right, so let's review what you've learned so far. So the first thing you learn is passive investing, where you buy and hold for the long run on the index and get roughly 11 to 12% returns annually based on historical performance. The second method you learn is trend following, right? Buying the index on the uptrend, selling on the downtrend using moving averages. And that will get you anywhere from 15% to 25% return a year consistently. So that's pretty decent, right? But is it possible to achieve a lot higher returns? Is it possible to achieve anywhere from 50% to even doubling your money every single year? Yes. And I'll teach you this technique in the Wealth Academy program, which is called swing trading. So in swing trading, you're going to learn how to buy and sell within just a few days, going in and out of the markets really fast and generating income every month for yourself, right? So with swing trading, we're able to achieve an average of 5 to 10% a month using leveraging of our capital, using CFDs. So if you're doing 5% a month, that's more than 60% a year if you compound it. In fact, it's about 70% a year. If you're doing 10% a month, it's more than 130% a year. So let me just show you the kind of results I get on my own trading statements. So this is one of the portfolios that I trade, and it doesn't matter how much capital you're trading with, whether it's $1,000 or $100,000, the strategy is exactly the same. What's important is the percentage you get on your capital, right? So on a typical month, for example, May 1st to May 31st, I'm getting about 13.43% return for that month. And that's pretty good income for myself for the month. Okay, and the next month, that's June 1st to 30th, that's 8% return on capital for that month. Okay, so if you recall, last year, in June 2016, it was Brexit, right? The UK voted to leave the European Union, and the whole market went down, right? Stock prices crashed in June of last year. So how was I able to make an 8% return when everything went down? And again, the answer is by short selling. As a professional trader, we make money whether the market goes up or it goes down. Because when it goes up, we buy low and sell high. Or we buy high and sell higher. That's called going long. When the market goes down, we do what we call short selling. Short selling means you sell, borrow shares to sell, and you buy back at a lower price, and you make a profit as the market goes down. So the thing to understand is to make money consistently, you have to make money in both directions. So in Wealth Academy, you're going to learn how to make money going long and going short at the same time. So you get consistent results every single month, right? So in July, you can see I got a 7.85% return for July, just 18 days of trading because I went on holiday for the rest of the month. In August, I had a 16% return on capital, so that was a pretty decent month for me. And in September was a 2.96% return for the month of September. The point I'm making to show you a few of my months of trading is this, right? You can't get 10% every month, right? You can't get 5% every month. The market doesn't go up in a straight line. Results are not linear. So on good months, I can get up to 16% or even 30% return a month. On bad months, I can get a 2% return, 1%, or even sometimes a negative month of minus 3%. I do have negative months sometimes. But if you average out my performance and my students, you're getting an average about 5% a month. Sometimes even an average of 10% a month, depending on how much capital you are risking in your portfolio. Okay? So if you think about it, if you're getting an average of 5% a month to 10% of a month, you can achieve financial freedom a lot faster than most people. So again, what's financial freedom? Financial freedom is when your income from your investments, your profits, are able to exceed your monthly expenses. Because the moment that happens to you, you're financially free. Okay? Your expenses are covered from your investments. So whatever work you do in your job, whatever money you make is a bonus, right? You can use it to do charity work, you can use it to save up even more money, or you can really enjoy yourself. And that's what we do for our students, okay? So to be financially free, you have to first of all define your expenses. For example, if you spend $5,000 a month in terms of household expenses, if you're getting a 5% return on capital on average a month, that means with $100,000 in capital, 5% of $100,000 is $5,000 a month. Okay? If you can get a 10% return on capital, then all you need is $50,000. And with 50 grand, every month on average, you're getting 5 grand a month, you're financially free. Now, I know some of you are thinking, Adam, I don't have 50 grand right now. I don't have $100,000 right now. So like I'm saying, my course will not make you rich overnight. I can guarantee you that if you follow the system and you save diligently, right, and you allow your wealth to compound in the next few years, whether it's 3 or 5 or 6 years, you are going to be financially free. Because you're going to master the skills and have the capital to finance your lifestyle for the rest of your life. And that's true freedom and security. The many emails I got from a very grateful student, his name is Alvin Lim, and he came for Wealth Academy a couple of years ago, and he wrote me this email together with my friend Conrad, who used to teach with me. And he said, Dear Adam and Conrad, about 4 years ago in 2008, again you can see it's years ago, I'm glad I took up my first course with Adam Khoo Learning Technologies Group in Wealth Academy 06 batch. Thanks to you, Adam, I've been empowered to think positive and out of the box, and that was the start of my journey, right? I'm now happily trading gold, and for the last 5 months, been bagging between 5,000 to 17,000 US on a monthly basis. And now Alvin is a professional trader, he's financially free, and he's able to do this from the comfort of anywhere in the world and making a great income. And here's a quick word from Alvin himself.
I came for WA in 2008. I remember that was just after I got married. So why I came was I just got married, and basing on what I'm earning per month, every month, I don't know how much increase I'll get. So I've heard things like people able to make money off the stock market, of forex, and of that. So did a bit of research, and I found Adam Khoo and Wealth Academy. So that's why I came for it. A couple of years down the road, after attending the program, I am actually a full-time trader, and I trade full-time. So basically there's no job to talk about. Wherever I want to go, I can go. So yeah, and every month, even while I'm away overseas, I'm still able to trade. As long as I've got my laptop, I've got my internet, I can trade. So while I was in holidays in Phuket, Korea, Japan, still goes on for me, I can still trade. So yeah, that's one of the, what do you call it, the best part in my life now. Yeah. In terms of income, right, I can fetch anything between 5k USD till good times up to 15-20k USD a month, right? So I believe that can actually give anyone a pretty comfortable life.